This month has been great for crypto. All altcoins are going up, and of course Bitcoin is leading the rally, but there's one altcoin that's doing a bit better than others, and that's Pudgy penguins. Now, does it make sense to still buy into the Pengu token? Let's have a look at the on-chain metrics, the data most people are not looking at. This is not the first video on Pudgy penguins on this channel. I publish the asset regularly over here. And especially at the beginning, during launch, there was a lot of attention. The very first video made 143 subscribers. The situation has slowed down somewhat. So the recent update got only 1/3 of the subscribers, but still people are searching for the token. So there is still potentially an influx of new investors. So could this push the price higher long term? At the beginning, it seems like Pudgy penguins was a plain money grab. So the price crashed down. It was launched by all the centralized exchanges from day one. They had a lot of allocation, and then they seem to have sold over time. That led to Pengu going down by 82%. But since the beginning of April of this year, things have turned around. This is now a rally of almost 500%. Now this is the US dollar chart. Here we've got the same chart relative to Solana. And since Pudgy penguins is listed on Solana, it always makes sense to check out the performance relative to the ecosystem token. There was slight underperformance of 15%. But in the end, the main question is always how much potential upside is there? Because when we buy a meme coin, we know that that's risky. We know this can drop by 50, 60, 70%. That's not really a surprise. The question is, does this volatility, this potential downside risk, get compensated with adequate upside as well? Now, there's a straightforward way to check for that. And that's comparing market caps. What we've got over here is the leading meme coins on the Solana blockchain. And Pudgy penguins is now the third largest of all of the meme coins. Number 1 is Trump, number 2 is Bonk, and number 3 is Pudgy penguins. The market cap is 1.4 billion. Number 1 is 1.9 billion. So really, that's only 30% of additional outperformance to get to place number 1. It's not that much. But we can also change the reference point. So instead of just looking at the Solana meme coins, we can have a look at all meme coins across all blockchains. And here, the upper reference point doesn't look that bad. Pudgy penguins is over here. It's at place number 6. And the 3 leading meme coins are all on the Ethereum chain. And to flip Pepe, there's more than a 3x from here. So if we work with the assumption that the Solana meme coin ecosystem is going to outgrow the Ethereum ecosystem, that retail meme coin demand will be rather on SOL, not on ETH, then that anchor might make a bit more sense. Now on this channel, I try to discuss the data that most people don't have easy access to. I don't discuss websites, I don't discuss hype, I don't discuss narrative. Instead, I think it's more important to look at who's buying, who's selling, what actually makes impact on the price. And one thing that definitely has an impact on the price is the supply, right? In the end, price gets determined by demand versus supply. It's the intersection. And what we see over here, that's the number of circulating Pudgy penguins tokens over time. The supply did not change since launch, but it will change in the future. In the future, the company and the team will get token unlocks. Those unlocks start at the end of the year. By the end of next year, the number of circulating Pengu tokens will have grown by roughly 20%. And then the big question is, will the demand grow to the same degree? It looks like Pudgy penguins now mainly gets traded on the centralized exchanges. Not that much anymore on-chain on Solana. Because have a look at the trending tokens on the Solana chain. Pudgy penguins is now at place number 29, and it's only got $450,000 worth of liquidity on-chain with a market cap of 1.4 billion. So that's really, comparatively speaking, a very little capital on-chain. On the X platform, so formerly known as Twitter, the token has almost 700,000 followers. But in the last 24 hours, we only saw 5,000 wallets interacting with the token, with the vast majority selling and not buying. The price didn't really move in the last 24 hours, but the buyers simply moved more capital than the sellers did. On-chain, we've got more than 500,000 wallets that hold some part of Pudgy penguins. This might be arbitrage bots to a degree that just have a few cents worth of the token, but it might also be some whales that have hundreds of thousands of dollars worth of the token. So we have to look at this into a bit more detail. What we see over here is the number of small retail investors on the left, medium-sized retail in the middle, and the whales on the right. So the way we make this distinction is by looking at minimum holding thresholds. If a wallet holds at least 40,000 Pengu tokens, that's roughly roughly $1,000 worth of the token, it's counted for the chart on the left. There's a 10x for the holdings in the middle, so that's now $10,000. On the right, another 10x, $100,000. So when we look at all of those wallets, right, more than 500,000 of them, only 18,000 wallets have actually $1,000 worth of the token. The vast majority has only insignificant amounts of Pudgy penguins. But what I find even more important about those charts is that the investor base is not growing anymore. Not for small retail, not for the whales. It just tends to trend sideways. Yet we have seen a massive rally in the price development, right? How is it possible that Pudgy penguins can go up by more than 300% when the number of investors is not growing? What caused this price rally? I think the answer is short-term speculation via the perpetual futures market. So the bets on the price, not necessarily direct trading with the assets, but just trading contracts on the asset price that usually have a lot of leverage involved as well. Because have a look at the trading volume. This is now the spot market. Pretty much all of the trading happens on centralized exchanges, not anymore directly on Solana. And the largest decentralized exchange, Binance, had a spot trading volume of 116 million in the last 24 hours. Now compare this with the perpetual futures market. Here we had 413 million worth of trading volume. So really the bets on the price, the short-term leverage, that's what's currently propping up Pudgy penguins. And I think there's a reason for this. As the volatility in the asset increases, as it goes up and down violently and isn't just stable, that means we get more attention on the token as well. Volatility creates attention. People are wondering what's actually going on with the asset, and that attention can then be monetized. Why do the market makers have an interest in monetizing attention, particularly for Pudgy penguins? It's because they hold the majority of the tokens. They hold the majority of the trading volume, they make money with the swaps, but also they just have the supply. And those token unlocks will be extremely helpful when there's more attention over time. The unlocks better happen when the price is comparatively high, not when the price is depressed. That's how the insiders cash out, right? That's the idea, that's the playbook. We want to create a lot of attention, we want to get a lot of people getting in, and then just over time we sell off our supply, make the money in the process, depress the price in the process as well, of course. Now, the perpetual futures traders are not stupid. They do bet on falling prices of Pengu every now and then. The funding rate of Pudgy penguins used to be extremely negative in the last few weeks. The issue though is that we've got the big market makers against us, right? The Binances of this world that have extremely deep pockets. So as there are more and more people betting on falling prices, the market makers, the price manipulators, they just buy up more on the spot market and short squeeze those positions until they get liquidated. So have a look at this, right? Recently, we see no negative funding rate anymore after the price rally. And then all of those shorts, they got liquidated. What then happens is that the price and the funding rate is a bit more in equilibrium. And then over time, the market makers can again sell off all of that supply that they bought for the manipulation. Just have a look at how much open interest, so that's the graph in green, correlates with the spot price. So that's the line in yellow. As there are more bets on the price, the spot price tends to go up. As there are less bets on the price, the spot price tends to go down. And currently there is a lot of open interest again, yet the funding rates normalized again. And so if retail doesn't again start shorting Pudgy penguins because of the tokenomics, because of the recent price rally, because the price is going up, even though no investors come in, if the funding rates don't turn negative and instead they stay at the current level, then the market makers can safely deflate the open interest again. They can safely delever, and that will depress the Pengu price as well. A clear shift in crypto has happened. Bitcoin is close to the all-time highs, yet the interest, the search interest, the retail interest is very low. Bitcoin gets supported because of Wall Street purchases, not because of purchases by retail. Nobody is searching for crypto or for Bitcoin anymore. The market is consolidating. The capital is concentrating towards a few winners. That's usual in any market, right? The vast majority of assets, the vast majority of players tends to go down, and there are a few winners. The winners take most. What we see over here is the performance of the smaller altcoins in the last year. And Bitcoin doubled in the last year, but most altcoins went down. And here's the thing, most people try to find the few assets that still do okay. They try to find the next dragon coin or the next go-to. But how likely is it to get proper allocation to those assets and not pick any of those other red assets and burn all the capital? The odds are clearly against us. So this approach is clearly problematic. It's not easy at all. The approach of timing the macro environment is also not that easy. This is Bitcoin over time, right? And of course, it does make sense to buy Bitcoin after it has dropped 70 or 80%. That's the best time to get in. We are very far away from this, unfortunately. The issue is also nobody wants to buy when we are depressed, because there's always a convincing story why Bitcoin will go to zero, why crypto is doomed, while nobody will get into the market again. We are far away from this, but in general, right, riding the macro is also not the easiest. Trying to find the next 10 or 100x altcoin is a problem. Trying to buy Bitcoin when it's extremely depressed is also not that easy. I do think there is an approach that's comparatively easy, where the odds are actually in our favor, not against us. That's by using the market structure to our advantage. This market structure here, right, that all of the altcoins go down all the time. Why do they actually go down? The answer is token inflation, right? It's new tokens that hit the market. It's the insiders, it's the venture capitalists, it's those paid influencers that get tokens, that maybe get them unlocked over time, that then simply just dump on retail. That's why all the retail investors lose over time. They simply get dumped on by the smart money. Why do venture capitalists like Andreessen Horowitz like crypto? Why do they invest in it? They do this because they get into the projects very early. They've got a very tight network. They've got a lot of capital to play with. They get in early and then they sell off and dump on retail. Or why are there so many compromised influencers that take money or tokens of a project to promote a certain cryptocurrency? This here, for example, is BitBoy Crypto, right? A dedicated review. He asked $35,000 for that. The reason is simply conflict of interest. It's profitable to do this. I, by the way, never took any money from any crypto project. I also will never take any money from any crypto project. I want to make my money in crypto in a different way. And that is through building skills that help us to distinguish the noise from the actual signal. And again, it's all about taking that market structure to our advantage. There is a way to make money with it. When a token like Balancer inflates in supply, when the supply is growing and growing because the users of the platform get tokens, because the early investors get token unlocks and they dump on retail, when something like this happens, then as a consequence, the token of course does worse compared to Bitcoin, Ethereum and Solana. So this is now Balancer relative to Ethereum, and it just constantly is going down. But we can just flip this on its head. When we go long Ethereum and short something like Balancer, we see a chart that's not possible to achieve with any single bet on crypto, right? This is very little volatility and very constant growth. This is now a linear chart. Here's the same on a logarithmic chart. Balancer is not a cherry-picked example. The overall altcoin market works like this. This is the unlocks over time for all of the tracked tokens on this website here. So the website is Tokenomics.ai. This is the weekly unlocks across all the tracked tokens, and it's above 600 million per week most of the weeks. So if there's not at least $600 million coming into the crypto space in a particular week, we see the altcoins do worse than Bitcoin, Ethereum and Solana. This is how those kind of charts develop. This is why we see red everywhere. This is why the strategy works so well. Again, instead of trying to find the needle in the haystack, it's much better to bet on the overall structure. When most people cash out, when Andreessen Horowitz makes money by dumping on retail, why don't we just get ourselves on the same side? I'm following this strategy for almost 4 years now. What we see over here is in light gray the performance I would have gotten had I just dollar cost averaged into Bitcoin. But instead I did the relative valuation plays that I just described, and that's why I got the black line return. So this comes from an Excel sheet of my personal portfolio. This is monthly data and it's got now 44, 45 data points roughly. I started the strategy with decentralized finance, so with borrowing and lending platforms like Aave or Venus Finance. But recently I do this with perpetual futures. So this started 2.5 months ago. I started with 40K and now it's at 60K almost. So that's almost 50% return in less than 3 months. I do not think that this will continue forever at that pace. But I do think in general, this is a money-making strategy. The strategy has already worked for almost 4 years, and it also works with leverage on the perpetual futures. And so basically we just flip this thing around, right? Everything that's red over here becomes green. Everything that's green here becomes red. The odds are finally in our favor. We are not gambling on random meme coins, lose everything. Instead, we make money the same way how the insiders and the venture capitalists make money. We make money when the dumping happens. And so I understand the problem, right? If you followed other people like BitBoy Crypto and you trusted them and you've lost your money with them because you just followed whatever they said, then I do understand if somebody else comes along and says, follow my approach, that it makes sense to be somewhat skeptical. And so I was thinking about this. How can I prove that I'm very certain that this actually works? Here is the offer. Watch 2 tutorials in the premium membership. So this is one of them. It's half an hour in length, how to use perpetual futures on Hyperliquid to bet on relative valuations. And then there's the second video over here, which is at least equally as important. Risk management with relative valuation bets using Hyperliquid. If you don't know how to manage your risk, you've got a big problem with those instruments. But yeah, the offer is to just watch those 2 videos. Once you've done this, then I don't expect you to start trading by yourself already and find the best opportunity. This is only something for the people that have been around for a while. This is, by the way, a few trades that have been made by other members that are shared over here in the chats. I think it is much better to do a little bit of hand holding, as in I will share my favorite trade that you can enter with that strategy. So you know how to use the platform, you know how to set up the positions. I will share then what asset I believe has the most likelihood of performing in the near future. You will then enter the position, hold it for a month, and if you don't make any money, if you're actually in the red with that position, I will simply refund the premium membership for free to you. You don't have to pay anything for premium if you're not making money with that first trade that I'm sharing with you once you enter. Of course, besides that very first trade, I'm also sharing all the other trades that I open. This, for example, was WorldCoin. WorldCoin has terrible tokenomics as well, and it underperformed Ethereum very consistently. But one thing after another, let's do the simple stuff first. Let's set everything up. Let's open the first trade, make that first profitable trade, make the first gains, turn ourselves around from being a constant loser to actually start winning. And then we can take it from there and become a bit more complex along the way. The premium membership is currently $125 per month. But again, I'll refund this in case you don't make money with that first trade. A link to premium should pop up directly over here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.